In his book, Extraordinary Popular Delusions and the Madness of Crowds, Charles Mackay described a specific psychological phenomenon: millions of people simultaneously impressing themselves with one shared delusion and running after it together. We see this pattern consistently throughout financial history. In the early 1970s, capital heavily consolidated into a few major companies like IBM and Xerox on the New York Stock Exchange, before the so-called NiftyFifty crashed by over 70%. The same cycle played out when the dot-com bubble wiped out a massive portion of tech and telecom valuations in the late 90s. At the peak of every one of these cycles, the market rationalizes sky-high valuations with a familiar battle cry: this time it's different. Right now, investors are pouring endless capital into artificial intelligence, treating it as a technological miracle. But the financial behavior surrounding it mirrors the psychological traps that triggered those previous collapses. Most people who put money into the market today truly believe they are completely insulated from these types of bubbles. The standard advice is to rely on the safety of diversification by buying into broad, passive index funds like the S&P 500. But the current health of that specific index paints a misleading picture of the broader economy. This bar chart illustrates what economists call a K-shaped market. At the top, we see a sharply rising line representing the growth of just a handful of major tech companies. But right below it, that declining line shows the reality for the rest of the index, specifically the 204 separate stocks within the S&P 500 that actually posted negative year-to-date returns, while the overall index hit a new high. The modern diversified portfolio is acting as a kind of financial anesthesia. It numbs investors to the fact that they are currently holding some of the most highly concentrated risk in modern economic history. A major reason for this concentration comes down to the mechanical plumbing of global retirement savings. By design, modern 401k accounts are set up to automatically direct the largest financial contributions toward the companies with the largest market caps. This pie chart shows the current makeup of the S&P 500. An unbalanced 35% wedge is consumed by just 7 tech-focused companies, the Magnificent Seven. Because of automatic weighting rules, out of every worker's retirement contribution, $2,358 flows directly into those specific stocks. This creates an automated pipeline of cash that continuously inflates the valuations of these few giants, regardless of their actual day-to-day business earnings. And this intense concentration of capital isn't an isolated American phenomenon. The obsession with AI hardware has synchronized trading floors right across the globe. In Taiwan, aggressive investments into semiconductor manufacturing have driven the TAIEX up 50%. Over in South Korea, the influx of money chasing silicon chips has caused the Kospi to explode, rising 96%. Entire national indices are now swallowed by tech conglomerates. Technology companies currently account for over 45% of Japan's Nikkei, while Samsung Electronics and SK Hynix alone make up half of South Korea's entire market capitalization. As a result, the global market is completely tethered together. There is no longer any major index left on Earth that an investor can buy without directly taking on the volatility of the semiconductor industry. If you track this massive global demand for AI hardware all the way down, you find that almost all of it funnels through a single corporate entity, TSMC. Looking at this comparison chart shows the scale of their dominance. That towering block on the left represents TSMC's 72% monopoly on global foundry revenue. Down on the right is their closest competitor, Samsung, sitting at just 7%. This creates a geographic vulnerability for the entire tech sector. Over 80% of TSMC's manufacturing capacity is located physically on one single island. But the structural crack goes deeper than geography. Corporations are taking out estimated borrowings of up to $700 billion to build out this AI infrastructure, while the actual downstream earnings for these massive tech giants remain in the 2-digit billions. In previous decades, investors could rely on geographic isolation to protect their savings. When the Japanese asset bubble burst in the 1980s, the damage stayed largely in Japan. Asian savings accounts were mostly insulated when the US Nasdaq crashed in 2000. Today, those firewalls are gone. A single geopolitical shock in Taiwan, a sudden breakthrough that slashes the demand for compute power, or corporate CFOs deciding AI tokens are too expensive compared to human labor, any one of these triggers would instantly cascade across every linked market. On top of that fragility, massive upcoming IPOs from companies like SpaceX and OpenAI are preparing to hit the market. These trillion-dollar public offerings will act like a sponge, soaking up crucial liquidity, driving up the cost of capital for everyone else. The global financial system has shed its geographic safety nets just as systemic stress is reaching a peak. The ongoing Gulf War is aggressively pushing up energy costs, which drives up inflation across the global economy. To fight that inflation, central banks are forcing the world to brace for a higher-for-longer interest rate regime. This line graph demonstrates the impact those rates have on tech valuations. As the interest rate climbs from 3% to 6%, the price-earnings ratio for these companies compresses, dropping from 32 times earnings down to 20 times. The actual utility of AI is a separate issue from its market price. The survival of these valuations depends on whether big tech can earn enough to outpace this compression. As McKay warned, the herd only recovers its senses slowly, one by one.